revenue recognition and you have a fairly decent understanding of what is the high level concept with revenue recognition, let us now understand the standard for expense recognition. Now, I want you to think about this in terms of the accounting equation where assets is equal to liabilities plus equity. And when there is an expense, maybe you are paying for it in cash, so your cash is going down, which is an asset. But if your liabilities are staying the same, then in order for the accounting equation to stay balanced, your equity will go down with the same amount. So an expense is something that is because of an outflow, right, which is obviously a depletion of an asset, right, which results in a decrease in equity. Another possibility could be, let's say the cash is not gone out, you've taken a product or a service from a supplier and you've committed to them that you will pay later. So your account payable has gone up. There has been an incurrence of a liability. And to keep the accounting equation balanced, your equity will go down and therefore it will result in a decrease in equity. So whether the decrease in equity is happening because a liability is going up or an asset is going down, the point is this is going to be called an expense, because an expense is something which reduces your equity. Whether that is happening because an asset is going down or a liability is going up. On the other hand, what we talked about in the previous video is revenue, which increases your equity. So if the cash has come in, your asset will go up and your equity will go up. Even if the payment hasn't come in, you record the revenue and your account receivable has gone up, your equity will go up. So revenues increase your equity and expenses decrease your equity, whether that is because of a liability such as account payable going up or that is because your cash is going down. All right, now the first point over here is matching principle, that on your income statement where you have your sales, your cost of sales or your cost of goods sold, which is of course going to be negative, then you have your gross profit, and then you will have your selling, general and administrative expenses, which will be negative as well, which will then lead us to our operating profit or earnings before interest and tax. And as discussed earlier, your cost of goods sold or cost of sales are your product costs, right? And the selling, general and administrative expenses are your period costs. Now, the sales which are happening, the product costs which you are going to show should be for those products which are sold. So if you made, let's say, cost of goods manufactured is 10 million, right? But actually only 90% of those goods were sold this year. So we will only show 9 million in cost of sales, and the appropriate revenue for those products will be shown in sales. So this is the matching principle, right? But the entire period cost will be shown. So let's say this year selling, general, administrative expenses were of 5 million, which is probably going to be your sales staff salary, which is selling expenses, general and administrative, right, rent, utilities, whatever. So let's say that is 5 million for this period. That will all be shown in this period because that is for this period, right? However, product cost, if it was for manufacturing of some of the goods which haven't been sold yet, that will be showing in our assets as inventory. That is not going to be expensed out yet. right? That expense will be recognized when those products are sold. So this is the concept of matching principle, that in every period, of course, the entire period cost will be shown, but the product cost will only be shown for those products which are sold in that period, right? And if you are a trading company, you're not a manufacturing company, so the goods that you bought in the current year which remain unsold will not be included in the cost of goods sold for this year because they are unsold, and they will be in your inventory, and when they are sold the next year, then they will be included in the cost of goods sold. Period cost, of course, they will be expensed in the period incurred, such as the rent paid for the office is for that period, and it will be shown as an expense in that period. Capitalization versus expensing. Very, very interesting concept. Again, think of this in terms of the accounting equation. So let's say my cash is going down, right? My cash is going down because I am paying for some goods which I am buying, but then my inventory is going up. So overall, there is no impact on my total assets, and therefore there is no impact on my total liability and equity, right? However, if I was paying cash for, let's say, rent, then my cash would go down and my equity would go down. So expense is something that will reduce my equity. Now let's say I'm paying cash, but I'm not paying to buy inventory. Let's say I'm paying to buy property for another factory that I want to set up, or I'm buying some plant for that factory, or I'm buying some equipment, and when I say plant I mean the machinery, or I'm buying some equipment, right, for my new factory. So all of these fixed assets which will give me economic benefit. What is a fixed asset or a non-current asset? Because your asset side we can write in terms of current assets, which can be or will be expected to be converted into cash within 1 year, or non-current assets which will not be converted into cash within a year, rather they will give me benefit for more than a year. So these non-current assets or fixed assets such as property, plant and equipment, if I am buying a property, plant and equipment, my cash will be going down, but my property, plant and equipment will be going up. Therefore, there will be no impact on my equity. This means the payment I have made is not an expense. It is capitalized. It is a capital expenditure, right? And you might have heard these terms OPEX and CAPEX, where OPEX is an operating expenditure such as paying rent, and CAPEX is a capital expenditure such as buying property, plant and equipment. So if I was doing an OPEX, then my cash was going down and my equity was going down. But if I'm doing a CAPEX, my asset is going up at the same time, right? And let's say I'm not paying for this in cash. Let's say I am paying for this in terms of an accounts payable, that I have gotten the new machine and my accounts payable has gone up. But at the same time, my property, plant and equipment asset will be going up. So there will still be no impact on my equity. So the main thing over here is with capitalization, your equity is not going down because your relevant asset, which is the capital, and when we say capital, it means it is your fixed assets, right, which will be going up. Now, why is this so important? For multiple reasons. First of all, this is important from the perspective of matching principle. How? See, if you're buying a factory, is this going to only help you produce goods for 1 year? The answer is probably no. It is going to probably have a useful life of 10 years, right? Let's take an assumption that the useful life of this factory is 10 years, which means that if you spent, let's say you spent $10 million on this and you recorded an asset of $10 million, if you expense this whole thing out in the first year, it's going to create a very bad income statement of that first year, because you'll have this huge expense of 10 million in the first year. And that will be unfair to the first year's income statement, because this asset is not only going to benefit or help you increase your sales for this year, it is going to help you create products which will result in sales for the next 10 years. So therefore, this value of 10 million should be equally divided, or at least somewhat divided, across these different 10 years, right? And that is where the concept of depreciation comes in, that, and there are different methods for it, such as straight line, where we will equally divide it across 10 years, or you can have an accelerated method, and there will be a separate learning module in which you will know about all these different methods, etc. But the point is that this asset's cost has to be initially capitalized and then expensed. So the cost, this 10 million cost, is not going to be directly expensed. The cost will first be capitalized and then expensed over its useful life. So I hope you are understanding this concept, and that is the first reason why we need to capitalize this expense. But the second reason is that we of course want to protect that hit on our equity. So if we will just expense it instead of capitalizing it, the overall value of our company will go down, right? Let's say if we don't record this asset of 10 million and we record this account payable of 10 million, our equity will go down by 10 million, which means our company's worth is going to look really bad, because the net worth of our company is basically the value of its equity, right? Equity is equal to assets minus liabilities. If you just take liability on the other side, and that is basically your net assets, which is the net worth of the shareholders, which is assets minus liabilities. So we don't want to do that, right? We don't want to recognize such a big expense. And therefore we will want to capitalize. But then as a analyst, you want to see which companies are doing aggressive capitalization and which companies are more conservative. And especially if you are comparing two companies, let's say we are comparing Apple and Samsung. So to be able to do an apple to apple comparison, right, we would then want to make sure that we make adjustments on both sides to bring them to a point where they are not, neither of them is either too aggressively capitalizing or too conservatively capitalizing. And you will learn more about this as we go through this material. So what is capitalizing? When a company acquires a long-lived tangible or intangible asset. If it is a tangible asset, it will be expensed out slowly through depreciation expense, and intangible assets are expensed out slowly through amortization expense. So intangible assets like software, you can buy a software but don't show it as an expense, capitalize it, show it as an intangible asset, and then slowly over the years, let's say it's a 10-year license. So if the useful life is 10 years, then amortize it, expense it out, amortize it over 10 years. So the company will first record an asset, right? Very, very important point here, and it's written twice. Acquisition cost plus any other cost to get the asset ready for its intended use. Again written over here, all other costs to make the asset ready for intended use is also capitalized. So for example, you are buying equipment, right, for your new factory. Now that equipment plus the freight inward, which means the cost to bring the machine to your factory location plus any installation cost or charges, all of this will be included in the value of the asset. Even though you might be thinking that the value of the asset, if you're going to try and sell to somebody, let's say you have to immediately the very next day sell that equipment to somebody else because you've changed your plans of expansion. They're only going to pay you for the equipment value, right? They're not going to pay you for your freight inward. They're not going to pay you for the installation cost. They're going to have to probably pay for their own freight inward to get the equipment to their factory and install it again over there. But accounting standards allow us to capitalize these expenses, not only the price of the equipment, but even the freight inward, even the installation cost. Any cost spent to bring the asset in a condition where it is ready to be used, ready for intended use, can be capitalized. These costs, this can be capitalized. And this is good from the company's perspective because they want to capitalize as much as possible because they don't want to expense it out. Why should they expense it out? They would rather have it as an asset on the balance sheet than reduce their equity, right? But they cannot capitalize everything. They can only capitalize what the accounting standards allow, and the accounting standards do allow you to capitalize the money spent or the cost incurred to get the asset ready for its intended use, which includes freight inward, which includes installation cost. And why would companies want to do that? Well, matching principle, because they want to spread the cost across the number of years, which means there will be less cost in first year or first period, right? So instead of recording all the cost in the first period, they will only record a little bit cost, whatever is the first year's depreciation, they will record in the first year, and then the rest will be spread across the useful life. Or if it's an intangible asset, amortization will be spread across. So this will lead to higher profitability in the first period or the period when the asset is purchased. And let's look at all the different impacts. So first of all, when you're going to capitalize it, your non-current assets on your balance sheet in your assets section will increase, right? In your cash flow statement, you have three sections: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Now, buying and selling of long-term assets is investing activities, right? And therefore, all that cash that is going out to purchase this equipment, it will negatively impact your cash flow from investing activities. So your investing cash flow will go down. What will happen over the useful life? Let's say it's 10 years. So over the useful life of that asset, every year you're going to be booking either a depreciation expense or an amortization expense, depending if it's a tangible or an intangible asset, right? And that amount of expense is going to reduce the net income. But this is over subsequent periods. In the first period, initially when the expense is capitalized, your investing cash flows will take a hit and your balance sheet is going to increase because your property, plant and equipment, if you are buying your factory equipment, will be going up. So it is an example of non-current asset. In subsequent periods, every year you will be booking some expense, which is basically you're going to be expensing out that capitalized amount either through depreciation if it's tangible asset or amortization if it is an intangible asset, and that of course is going to decrease your income for that period, and your value of the asset on your balance sheet will be going down. So let's say you bought it for 10 million, right? So initially it would have gone up by 10 million, but then every year you're having a depreciation of, let's say, 1 million because it's equally distributed across 10 years. So then on your balance sheet after 1 year, it will have a carrying value of 9 million, right? Because 10 million is the original cost, 1 million will be the accumulated depreciation. Next year it will become 2 million. The accumulated depreciation will become 2 million. So it will be 10 minus 2, which will become 8, will become the carrying value. And like this, the value on the balance sheet keeps going down as the income statement records the expense each year. And of course, this is expense, which means every time the expense is recorded, your equity will go down, right? And equity, if you look at any financial statement, the portion of equity, so you have assets on one side in a balance sheet, right? Liabilities and equity. Assets, you have your current assets, your non-current assets. In equity, you have common equity, which is the original investment of the shareholders, and then you have their profits from over the years which they have not taken out from the company, they have left them in the company. That is called retained earning. So this is what is going to go down as the depreciation is booked, and overall equity will be going down because retained earning is part of equity. All right, if you don't capitalize it, if you directly expense it out, naturally there will be no impact on future earnings because all the expense is going out in this current immediate period, right? So the immediate recognition of the expense is going to impact your current profitability. This year you're probably going to have a huge loss because the whole 10 million expense you are recording this year. So naturally this year's profit and loss is going to be terrible, but then your later profits will be higher because there will be no depreciation expense. So if it is expensed out, what will happen on the income statement? The first year, your net income will be very badly affected. It will decrease by the after tax amount of the expenditure. Why after tax? Because obviously this expense which you will record will completely destroy your profit for that year, which means less profit means less tax. So you will get a tax benefit on that huge expense because it will reduce your profit and you will definitely not have to pay tax on the reduced profit. But still it is going to destroy your net income for that year. And since you're not capitalizing anything, therefore no depreciation or amortization expense will be required. No capitalization is done, so no asset is recorded on the balance sheet. However, your equity is going to take a huge hit because that's what happens when you book an expense. And in your cash flow statement, you have cash flow from operating, cash flow from financing, and cash flow from investing. This time it's not going to show in cash flow from investing because we are not buying a long-term asset, right? We're just showing it as an expense. So that will be treated as a operating cash flow, and that negative cash, that cash outflow in the cash flow statement will not show in cash flow from investing activities, but it will show in cash flow from operating activities, and therefore your operating cash flow will go down. Now this table might look a little bit haunting to you because you might think you need to memorize this. I don't think you should even consider memorizing this table. This is all very, very logical. If your concepts are clear, whatever solution, whatever question that you get, you should be able to intuitively get to the answer. And I'll walk you through this whole table and explain everything to you in a logical way. And that is how I want you to try and understand these things. Try to understand the concept. Now, if you're capitalizing something, which means your assets will be recorded. So therefore, obviously, your total assets will be higher. If you're expensing it out, then definitely your total asset will be lower. Very, very logical. And if you're expensing it out, naturally your equity will take a hit and therefore equity will be lower as well. If you don't expense it out, if you capitalize it, your equity will be higher. If you record the expense in the first year and then you don't record the expense in the subsequent years, so you're not properly dividing the expense across the useful life, then your income variability will be very high, which is not good. This is not good at all because this is violating, because why do you think this is bad? Because it's violating which principle? It's violating your basic matching principle, which is a basic requirement of your accrual based accounting. Right, that we need to have that expense spread across its useful life, because that factory is going to give you benefit for 10 years. So the cost should also be booked across 10 years. And therefore, if you do it properly, then your income variability will be lower if you capitalize it. Which means if you equally divide it, then your compared to if you don't equally divide it and you put all the load in the first year, then in the first year the income will be much lower if you expense it out, but it will be higher if you only put 1 million expense in the first year. If you put 10 million expense in the first year, definitely your income will be much lower. And for later, here will be higher because you've expensed out the whole thing in the first year, and here it will be lower compared. So the capitalization later income will be lower compared to the expensing. But I don't think it should be saying higher or lower. It should be saying appropriate, right? Appropriate. So that is probably the right way. But here it will show lower than what it should be, and it will be showing higher than what it should be. Now, if you will expense it out, your cash flow from operations is going to get a hit, which means that will be much lower because there's going to be a huge cash outflow. However, if you capitalize it, that cash outflow will be shown under cash flow from investing activities, and therefore the cash flow from investing activities will be lower in the case of capitalization. Now, your debt to equity ratio. What is debt to equity ratio? Debt is your liability which you have to pay back to the bank, right, or whoever you have borrowed money from, and equity is your own money in the business. Now, if you are capitalizing, your equity will not be taking a hit. It will be a higher amount, which means your debt to equity ratio, let's say it's no impact on debt, it's the same, but with a higher equity, this overall ratio will be lower. So let's say debt is 10 million and equity is 100 million, right? So this is 10%. Compared to if you take that hit of equity by expensing out the 10 million in the first year, so now your debt to equity ratio will be, debt is still 10 million and equity is going to be 90 because you took that 10 million hit, right? And therefore obviously 10 divided by 90 is going to be higher compared to 10 divided by 100 or whatever, 99, right? Obviously that 1 million depreciation expense will be there. But the point is that the bigger the numerator, the lower the ratio. In case of capitalization, equity will be higher, right? Equity will be higher, and therefore your debt to equity ratio will be lower. Okay, now let's move on to interest coverage ratio. Now, interest coverage ratio means what? Interest coverage ratio means what is the interest that you have to pay, right? So interest expense divided how many times you are generating income. So what is your income divided by your interest coverage, that how many times you are earning compared to what is the interest you have to pay. Now, generally, what will happen is that if you are capitalizing, which means your profit for the first year will be higher, and if the profit is higher because depreciation expense will be lower, then your numerator will be bigger, and if your numerator will be bigger, then your interest coverage ratio will also be higher. But then later, obviously, compared to the expensing, it will be low. So what happens in the expensing is that you book all that expense in the first year, and then later you have less expense to book. Later your income is higher, and which means in later years your numerator in your interest coverage ratio will be higher, and that will lead to a higher interest coverage ratio in later years if you are expensing out in the first year. Similarly with return on assets and return on equity, so since your net income is higher in the first year, so your return on assets and return on equity will be higher as well. And with your expensing, since the income is higher in the later years, therefore your return on assets and return on equity will be higher for later years for the expensing option.